And I believe you can do it if you understand the steps and you become an expert at adjusting. It doesn't take forever to become an expert at adjusting. Just understanding the concept of it and then continuing to practice it, practicing it before the game starts, right? It's like, football practice, basketball practice, hockey practice, whatever. You have to practice before the game so you can understand what you're going to do in the game. And you just can't be willy-nilly about the process, jumping into a trade and not knowing how to get out of the trade or how to adjust the trade or when you're going to say uncle. All of those things are super important, but let's break down the 7 DTE process as detailed as we possibly can so you can understand how you can make what I believe is a significant amount of monies with this type of short-term trade, and that it's for more people than the 0 DTE trade or the 1 DTE trade. It's a lot easier to manage, in my opinion, than the 0 DTE trade or the 1 DTE trade because you have a little bit more time, but you still get that type of fast gratification or short-term gratification that we all kind of crave. Even someone like Ernie who does our long-dated type of Dorian strategy, which is awesome, right? He's not going to never go away from that because that's his temperament, and he does well with that type of strategy. But he even has a kind of a pool to these short-term trades, right? And so to me, this 7 DT trade is a good type of bridge. You're not doing something that's 0 DT unless you absolutely ready for it. You're not doing something that's 1 DT, which has the most overnight risk. And, but you're still doing something that keeps you engaged, that expires pretty quickly, and that you can make a significant amount of monies off. Right. So we've been talking about. I'm going to give you some white space here. We've been talking about having 5K, right? $5,000 per contract that you have. Right. So if you only have 5K in your account and you sell a 7 day trade or 7 DTE trade and you collect at least $100. Okay? Well, if that goes to zero, if you hold it to expiration, which we don't, if that goes to zero, then that would be a 2% return on your capital in 7 days. Right? 2% return on your capital in 7 days. That is phenomenal. If someone says that's not, then run from them, right? Because they don't understand that these kind of numbers can be just awesome, right? 2% in a week is awesome. Yeah, some of these people are doing better than that. I know Jim, you've done significantly better than that. I know Jack has done significantly better than that. Dr. Meadows would at during periods of times, right, doing significantly better than that with the 0 DT type of trade. But in all worlds, in my opinion, 2% is excellent for a week. It's excellent for a month, in my opinion, right? So, but if you're getting out of that trade with 50% profit, right? You're taking 50% profit off what you collect. So that's going to equal that you're getting out at $50. Well, that still is going to equal 1% in a week. That's still excellent. If I just said that 2% is good for a month, then obviously 1% for a week is good. So that's 5K. You're bringing in $50. If you did that, let's just say in a 4 week period, that is $200 that you have made off your monies in a month's time. That could be a really good supplemental income for a lot of people, right? But if your goal is just to grow your account, well, you're growing your account at a really substantial rate. That's 4%, not including compounding interest. Including compound interest is obviously going to be more than 4% if you can do what we just indicated. And I believe you can do it if you understand the steps and you become an expert at adjusting. It doesn't take forever to become an expert at adjusting. Just understanding the concept of it and then continuing to practicing it before the game starts, right? It's like, football practice, basketball practice, hockey practice, whatever. You have to practice before the game so you can understand what you're going to do in the game. And you just can't be willy-nilly about the process, jumping into a trade and not knowing how to get out of the trade or how to adjust the trade or when you're going to say uncle. All of those things are super important, but so many of us, because we have this urge to jump into the markets, we jump in without having the tools, right? We run into a burning building without any, without the hose, right? Without any water, without any gas mask, and next we're passed out. And we don't want that to be the case. We want to be able to make a ton of money off this strategy and do it as safe as possible. You will have to know how to adjust because adjusting will happen, just like we just experienced by adjusting Paul's trade and Ernie's trade and then my trade. You're going to have to adjust it. but you can still win at a super high level if you have to adjust it. All right, so let's break down this trade. Okay, we're using 5K. We're going to go out 7 days. Okay? And what we're going to do first is we're going to check the expected move by doing the straddle price. The straddle price right now, let's just round this up to 80. That's 80. Its expected move is 80. It's expected to expire within 80 points from where it's currently trading at right now, and that's about 43.61 on this SPX. Now, the expected move on the TastyTrade platform is saying 78. That just rounded up to 79. So it's fairly close right now to the straddle price of what the expected move is. So we're going to say 80. So 80 and 80 is 160, right? So we're gonna take that 160 and we're gonna say, okay, 160 is 2 times the expected move. And if we wanted to be that far away, we'll know that's what strike that's at. So if we take this 43.60, what it's currently trading at, and we minus 160, well, that's gonna put us at about the 4200 area on the put side. Okay? If we take that 43, let's just say 43.60, and we add 160 to it, that's gonna put us at 45.20 on the call side. Okay, so 4,200 for the put side, and then 45.20 on the call side. That's 2%. That's 2 times this expected move, basically, if we rounded that up to 80. Okay, so if we went to the call side, and let's just see what that looks like. On the call side, that's 45.20, and we're going to do a 10-point wide on these trades. Right, so we're 10-point wide. That's where we initiate the 7DT trade at from the start. Then we're going to go to this put side. We're going to 4,200 strike. It's way down here, and that's a 8 delta right now. We're getting a 10-point wide spread. So we are collecting $85 to $90. It's jumping around. You want to collect $100 after fees and commissions. You want to collect at least $100 on this trade using only a 10-point wide spread, because a 10-point wide spread will have a max loss of $1,000 before the credit you receive. So if you have $1,000 max loss minus the credit receipt, let's say it's $100, so the most you can lose is 900. So that's the most of the buying power that you're using of your 5K account, or how much you're allocating for each contract. 5K, you can have a 5K account, or you can allocate 5K for each contract that you do. Right, so but I'm going to round that up and say we're using $1,000 here. Right, so we got $4,000 more we can use, but we're not going to initiate that. We're going to put that 4,000 to the side to be able to adjust if we have to deal with issues that will come up eventually. Right, so out of the last 3 trades, we were able to win twice without adjusting, and so this third time we had to adjust. Okay? If we didn't adjust, maybe we wouldn't have had to right now, because the market just jumped back up, but that's fine. We adjusted. It's still a really good trade. Okay? If we go over here to this Thinkorswim platform and look at the adjustment we just did, it's up, right? It's up $23, $28 on the adjustment we just did. That's the P&L open. So that adjustment was beneficial, even though the market has come back about 50% off its lows, right? Or since we put the trade on. All right, so let's jump back over here. And we're not receiving $100 here, so we have to come off that 2 times the expected move stance, because it's just not going to work. So with these 7DT trades, I'm okay, and what we're teaching is okay, is to go as high as a 10 delta. Okay? Let's go as high as a 10 delta. The market has been falling a lot, so if you're nervous about that put side, you can move this call side up a little bit, or a lot a bit, because the put side is an 8 delta, this call side is a 4 delta, so you can move this up quite a bit. So let's say we move this call side up to a 7 delta here and did a 10-point wide spread. Well, that's going to give us 115 right there, right? 115 right there. So that's going to be more than $100 after fees and commissions right now. And we're going to have a super high probability of winning. We got an 8 delta on the put side, I believe, a 7 delta on the call side. So that's 15. You minus that from 100, that's 85% chance to win, at least based on the deltas. That's an 85% chance to win at least something at expiration. You guys know we're not going to hold this to expiration. We want to get out of these trades with 50 to 55% profit. So if we collect 115, 120 or something such as that, we want to make $50, well, that's going to be getting out at 50%, or a little less than 50% if we collect 120, right? But we want to focus it on after fees. So if we collected $100 and we get out at 55%, that's going to do it. We should be fine to get that $50, which will give us 1% on the 5,000, right? If we make $100 off the 5,000, that's 2%. You can shoot for that, but what I'm shooting for and what we're teaching is getting out at 50 to 55%. That's going to keep your probabilities around 85 to 90% of being able to win the amount you want. Not just win, but the amount you want to win. And that's the key, right? You want to make a really good amount on this percentage wise, and it only can add up. So you just think about it. If you're making 1% off 5,000. Well, you can make 1% off 10,000. You can make 1% off 15, and so forth. And that's how you can scale this type of trade to something really substantial that even can be, financially life changing. All right, so this is how you can determine this. You can decide to go up a little higher. You have to decide what is your feel for the trade and your risk parameters for the trade. But you don't want to start off with something any wider than 10 points wide on either side. This is the 10 delta on the call side, as you can see here. Now that's giving us 145. If we wanted to do the put side at a 10 delta, we don't have to do this. I'm saying you want to go no higher than a 10 delta, but this is the 10 delta on the put side. So now you can see you're collecting 170, right? 170, 175. Let's say you're getting 170. So you take the 170, you divide that by 2, that's 85. So you made $85. Let's say after fees and commissions, let's say you made $80. So you got the 80 divided by the 5,000. You just made 1.6% of your monies in 7 days at best, right? At the most, it's 7 days. Most of the time, you're going to be out of this trade in 2, 3, 4 days, okay? Which is really, really nice. Hitting that 50%, 55% mark in that amount of time, it's always nice. And then you can, take a day off, redeploy the next time. That's what I usually do. Or you can redeploy the same day. I usually wait for the next day, kind of let things clear, see how things are going, and reposition a new trade. All right, so that's how you're going to set up the trade. I can't give you all the details right now, but that's the gist of how you would set this trade up and try to optimize it based on your risk levels, but not going any higher than a 10 delta, no wider than a 10-point wide spread. All right, to initiate. Then you have what we call adjusting the trades, right? We talked about taking it off. Now let's talk about adjusting the trade. When you adjust the trade, you're going to adjust it based on what we're teaching is risk zones, not putting on a stop loss, because sometimes further you go out, these stop losses can be hit at bogus times. I know a member put a stop loss yesterday on a trade that was only 5 points wide, iron condor. He, a few minutes later, was hit on it because it was a bad read on his iron condor, and he already got stopped out. Nothing more frustrating than that. So this type of trade we're talking about is you're using green, yellow, and red zone type of parameters that we talk about in lesson 4 in the Dorian Trader School of course 1. Okay? And so you have to know how to adjust. You have to know how to do the roll away. You have to know how to do the roll up. You have to know how to do a roll out. And when you're adjusting, as we talked about earlier, you have options. You can adjust the traditional way by not changing anything except the deltas, keeping the width of the spread the same. You can adjust by making the width of the spread wider on both sides. You can adjust by adding a contract on both sides. You can adjust by adding a contract only to one side. If the market's going down a lot, you can pay for the adjustment by adding two or a contract to the call side, but not the put side. Things like that. You have a whole toolbox of ways you can adjust this. We try to teach you the different strategies you can use to adjust this, and then you have to determine how you're going to deploy it, which one you're going to use. You're not going to have to get exotic most of the time, but you want to know how to get exotic so you can win on these trades all the time. But you have to have an uncle point once you use more than 5K. So you start off using 1K. If you have to adjust, add some more contracts, go a little wider with the width. And then once that gets up to 5K on that one contract, you say, okay, I'm done. I'm not going to add any more risk to the trade. And then you adjust traditionally if you can still. And then once you can't adjust traditionally anymore, then you just start adjusting for a debit, and you will have a little cushion based on the credit you received. And then eventually you'll run out of the credit you received, and then you'll adjust for a true debit that you have no way to win on the trade, but that's fine. You do not want to lose a big amount on this trade, and a big amount is anything over 4 times the credit that you originally received. So if you originally received $100 in credit, then losing more than $400 on this trade is not acceptable, right? You do not want to do that. You should not do it, and you do not want to do it because you want this trade to be something that you can make a substantial amount of income on into perpetuity for supplemental, or if you have bigger aspirations, full time.